Welcome back to the channel. As always, if you are copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, I'm going to speak today about a stock called Fortinet, ticker FTNT, in the information technology sector, more specifically cybersecurity. So, in terms of what the company does, they make firewalls. So, think of them as the digital walls protecting corporate networks. And for 20 years, they dominated this market with superior technology. As you can see, this is a stock that has been rising for a long, long time. But I think that this trend, which, as you can see, at least on the moving averages, might be starting to change. And I'll explain why in a second. So first of all, you can see that there was a massive gap here of the August earnings report. So the company went from almost 100 all the way to low 70s, and it's now recovered to the mid 80s. And why was that? Well, during this earnings report, the company announced that growth had suddenly stopped. Okay, so here's what happened. Revenue growth collapsed from 15 to 20% to 7%. So we're talking about a half in terms of revenue growth, which for a sector like this, it's definitely worrying because you have companies out there growing at a much, much higher rate than that. More alarming, billings dropped to 0% growth, right? So that's in a sector growing 15% annually. So 0% means that you are dying, and we will exemplify that with a few other things as we go through this video. So as you can see, the stock fell quite a bit, and that typically signals the start of a trend change. Now, I think that we could see further catalysts that confirm that this could be getting worse. So management alluded to the reasons of these results on timing. So essentially, they were claiming that customers were delaying firewall upgrades, and when you look at the thesis, the narrative that has been bolstering the stock price, that is one of the fundamental reasons. So we could see the narrative change, leaving little to no reason why stockholders should own this stock. Because if we look at what's happening in numbers, right, we can see that they actually lost almost 2% market share to Palo Alto in the last 12 months. And in a $50 billion market, that's almost $1 billion in annual revenue gone. I mentioned before that the management thesis was that 25% of firewalls need replacement, but analysis from different houses shows that they are already halfway through the cycle with minimal growth. And that could point that customers are choosing competitors over the technology. We'll explain how that plays out as we go through this. We mentioned as well that while CrowdStrike grows at 32%, Palo Alto 16, in a 15% growth industry, these guys are growing at 12. So it doesn't look good when you look forward how that compounds. But also something that we've noticed that is quite relevant is that CEO and founders sold $62 million of stock in 90 days. And whilst that is not necessarily an automatic bearish signal, it is faster than the normal selling pace, and it could signal that the timing, right? They anticipate something is coming in the next few months, and I believe that it could be. As you see here, we have the earnings coming on the 5th of November, and by then, the firewall refresh should be in full swing. So that could be the moment where that narrative that has taken us to this point completely falls apart, right? Of course, we will hear as well about other areas such as revenue growth, billings growth, and guidance. And at the moment, the numbers, if we look at here, the guidance don't look great. So you see, for example, right, a company in a sector like this growing EPS at 6%, but they are assuming that that is going to uh, increase in terms of EPS growth. So we could see those assumptions getting changed, which of course will drastically change the perception of market competitors about the stock. Let's say that the results generally happen that way, right? We could see catalysts, say around late October, so over the next few weeks. The company stepping in, kind of like warning the investment community about this. Because when you look at the competitors, uh, they are also expected to report around that time, right? So late October, early November. And how could that materialize? Well, they have a value proposition that is failing across multiple fronts. So they have uh, cloud security, cloud-based security called SASE, and that market is growing at 27% annually to 45 billion by 2030. But unfortunately, this company, Fortinet, has only penetrated 10% of their own customers versus 30 to 40% of their competitors. So they are definitely falling behind in this space, which, as we know now, with the rise of AI and new technologies, it's the way to go, as opposed to the legacy systems. We also see a shift in customers' infrastructure in terms of the vendors. So many enterprises are significantly decreasing the number of security vendors that they work with. In some cases, the numbers are so stark as dropping the list from 75 to 10. However, Fortinet has a relatively limited suite of products, about 15, whilst Palo Alto offers more than 60 products. So they cannot really compete with certain segments of the market, perhaps a little bit smaller, where you can still find growth, and they have a more uh, existing client base that they have to deal with. But unless they are able to um, increase the value that they deliver to those clients, which um, doesn't seem like they're coming up with anything like that, then there's no growth in that. And that's where you see those projections materializing. So, of course, that has resulted in the valuation taking a plunge. As you can see, the stock was trading over the last 12 months at about 40 to 50 times, right? But now they're trading at 33, reaching as low as 29 in terms of next 12-month PE. So that signals that the market does not see the prospect of growth in this company, especially when you compare it with its competitors that are trading at literally double in terms of valuation. So the AI revolution is a big one as well. We are seeing how the market has been bolstered a lot by AI, but all the competitors from this company have AI products, and Fortinet is the only one that doesn't. They have patents, but they have no AI products. So the technology gap, and this is important because the capabilities of AI are increasing weekly, is widening significantly. So all that leaves us with the following setup, right? We could see earnings in October with the stock going to the downside even more. We could see violent moves taking place. If we have a look at the options, we can see how the market is perceiving that. So we could look at, for example, December, the volatility is 40%, which is not very elevated for a company in this space. But what if we see that change in narrative, right? And the company suddenly moves very violently. We could see an increase in volatility, which of course, if we are on the right side, is going to make our play even more profitable. In terms of risks, we have to be cognizant that, of course, the firewall upgrade refresh might come delayed. That is a possibility. Again, I think the probabilities are not there, but it could happen. And we take a look at the balance sheet. Something to bear in mind is that the company has almost 3 billion in net cash, which limits uh, the uh, the way that they can maneuver crises like this and adapt to the new cycle. But again, even if they have a lot of cash, it would be very expensive for them to actually be able to do that. I think an even greater risk, despite their large market cap, is that they get acquired by a competitor. But overall, I do think that this is a stock that will likely underperform in the short to medium term. So likely we'll be looking at expiries of January, perhaps February, where we will probably see a price target of 75 or potentially below. Hope you enjoyed the video. See you soon.